Let's show you the latest in the markets. We're deeply red, as we say. The S&P down 3.5%. Crude's down a lot. Gold, which has been hitting record levels almost every day, is lower as well. The dollar is sinking. Hey, but they got their lower 10-year. We're right around 4%. And we're watching all of that, of course. The Nasdaq's getting crushed. Small caps are getting crushed. And, Josh, I suppose so much for that clearing event that some had predicted yesterday would bring.
Yeah, I was on the show 2 weeks ago on a Thursday, and I said we're basically in a bear market. Statistically, the median stock was there. The index hadn't quite gotten there, but it felt like a bear market. And one of the things I've said maybe a million times since I've been on the show is nothing good ever happens below the 200-day moving average for the S&P. Where we stand right now, we had this conversation last week. Or Tuesday, we have a clearing event when this big bad announcement finally comes out. And it's true, Scott, a lot of these big bad announcements have served as capitulatory buying opportunities, clearing events, whatever you want to call it. What makes this one different is that it's not a market event. Secondarily, it is. It's really an event that impacts the real economy, Main Street. And one of the things I've been focusing on is the consumer. The consumer is what kept us from having a recession in 2022, what kept us from having a recession in 2018, because while things were rough, nobody really lost their job. And that's not going to be the case this time around, unfortunately. So I still believe what we see on Friday is going to be very consequential with the jobs number. It'll tell us whether or not this tariff stuff already started to impact hiring and firing in the month of March. My concern is that it probably did. And then we're going to get 2 weeks from now, we're going to get all these earnings calls. And I'm telling you, the forward guidance is almost going to be like a Saturday Night Live skit. There's absolutely nothing most of these companies can say because they don't know enough to have an opinion. So it's a really tough time. It's not a clearing event. And while opportunities are being created by stocks falling, there might be better opportunities later. We are in a downtrend, in a bear market, and people need to behave accordingly.
Joe, consumer discretionary is down more than 5%. It was down 7%. It's come back just a smidge off the lows. RH, just getting crushed. Show RH, guys, if you would. It was down 40+%. There it is, almost 42. Nike is getting hammered today. Anything remotely sensitive to the countries which got these tariffs put on, they're all hurting. To Josh's point about these capitulatory events, we've all been wondering, where was the market after a pullback already heading into a historically pretty good month? Jonathan Krinsky writes a note today from BTIG. We think this should finally trigger some real capitulation signals, which would suggest the end of this move tactically, rather than the start of a fresh leg lower. To be clear, we don't think we're done with the correction broadly and continue to view rallies within the context of a larger decline. Thinks today could be a near-term inflection point because of the ugliness that we are all witnessing on our screens today.
I don't think you have the visibility to share the type of universal conviction surrounding when the timing of a bottom for equities can be. I think that there is too much ahead of us in the upcoming earnings season. In particular, I am highly concerned about the fact that while everyone's talking about the potential for an economic recession, how about the potential for an earnings recession? That's a real potential possibility. So,
Man, what? Oh my gosh! You know, if you're talking like that, you know, on January 1st, okay, I'm going to set you up to keep cooking over there. On January 1st, earnings expectations were expected to be up 12.2%. Today, they're at 8%.
Okay.
Now you're talking about a potential earnings recession.
Well,
negative earnings growth.
So the impact, and everyone's going to say, oh, well, that's crazy. Earnings are going to be resilient. I think it's important to say you don't know. And I don't think anyone knows right now what the global effect is going to be on prices and where the effect of pricing is ultimately going to land. Let's keep in mind something, okay? First of all, there's going to be a sensitivity for corporations' ability to pass through the cost of goods rising to the consumer. The consumer is now already feeling the negative impact of the wealth effect being damaged dramatically, $3 trillion today. So do we really think there's going to be resiliency on the part of the consumer to say, okay, we're going to keep buying, we're going to keep buying, we're going to keep flying around the world? It's just not going to happen. And ultimately, I think what everyone continues to say is, well, this is going to be a real inflationary outcome. I think at the end of the day, this ends up being massively deflationary and really, really damages demand for goods.
Well, you look at what yields are doing, Jenny, on that point, do you have to take your base case at this point to recession or close to it? Firms have been cutting their growth outlooks almost every day over the last couple of weeks. Piper Sandler, they do today as well. Q2 real GDP estimate, they were at 0. They take it a touch lower to minus 1%. So, you know, that's kind of where we are. Some suggesting that earnings estimates are going to need to be significantly revised downward from here. And we can talk about the multiple and all that and levels in a moment. But base case, recession, close to it.
Okay, let's say close to it. And then the question becomes the common question about recessions, which is how deep and how long. And that's where you really get to the meat of it. And this goes to exactly what Joe said, which is we do not have enough information right now to speak with conviction about any of this. So Goldman, for example, put out some really useful data this morning. And they said, okay, if there's an 18% effective tariff, and I think we know it's 24 or something, that would bring earnings to 248 to 250. That shows about flat, right? Flat, so it's not quite recession. But let's say we're at 248 on earnings. What multiple are you going to pay? Are you going to pay 18 times? That would put you at a market of 4,500.
Let me give you some other numbers while you're at it, and I'll give it back to you to continue cooking as well. So Goldman was at 280, okay, for next year. They've come down to 269. 16 times that. I mean, depending on what the economy does, you go into a recession, is 16 times reasonable? Maybe. That's 4,304. 269, 16 times, that's 4,304. If you say, well, we can do a little bit better than that. We can do 18 times. If it's 269, that's 4840, 4842. If you want to be presumptuous and say, hey, we can do 20 times, guys, even if earnings estimates continue to come down and the number is $269 and you want to go 20 times, that's 5380. That's still below where we are today.
Right, down
and that's maybe what some would say, best case scenario under these conditions.
Right. So what do you do? Right, what do you do?
You tell me.
All right, well,
you buy all dividend stocks? I mean, staple. Joe's been buying the TLT 3-4 different times over the last week.
Okay, so here's what I think you do. I think you keep perspective. Josh said, let's assume that we're in this rotten environment. You must behave for that environment, so you behave well. You focus on the long term and you look through it. And I think actually most people's portfolios are already positioned for this. So when we think about last year, as we're wrapping up last year, I was really upset because I kept getting calls and kept getting pushed on like, I missed out. You know, I had a terrible year. I didn't keep up with the market. I wasn't up 26%. Why? Because they were in strategies like what Ritholtz manages, where they're balanced, right? Where there's some bonds, where there's some international stocks, where there was some small cap. So last year's pain with respect to relative underperformance is this year's gain with respect to relative outperformance.
I don't think